Hi, this is Scott Martindale of Sabrient Systems with this week's Sector Detector. So far this year, the market has been on a steady rise in a narrow channel with very little volatility. It seems that the bulls were just looking to recruit reinforcements for their assault on the highs on the S&P 500 and on the Dow blue chips, after already taking out the all-time highs on the Russell 2000 small caps and the S&P 400 mid caps. So they just needed an entry point. And the question is, well, was that it? Was that the entry point, all the entry point we're going to get? The market for the past several days showed some elevated volume and elevated volatility. But after things calmed down with some words from the Fed and a successful Italian bond auction, the VIX has dropped down below 15 again. So, you know, I had said that S&P 1500 would probably be heavily defended, and it was. It turned out to be good support, and the market looks ready to rumble again. The technicals look good. And Sabrient's SectorCast ETF rankings seem to be, although slightly less bullish this week, they're still bullish. I'll talk more about that. I still expect the market to challenge its all-time highs before anything else happens. It appears that we're into the economic expansion phase of this recovery, with over 90% of the S&P 500 companies having reported earnings. Around 70% of them have beaten earnings, and that is well above average. So if we look at the S&P, the Sabrient SectorCast ETF rankings of the 10 U.S. sector iShares, technology, IYW, has really set itself apart this week. It's scoring a 94, very impressive outlook score. Financials is in second place at a 62, and then consumer goods, IYK, has jumped into third place ahead of healthcare. IYW now boasts the lowest forward PE, the best return ratios, the most support from Wall Street analysts, and also a very strong projected growth rate. IYF displays the second best forward PE and the second most support from Wall Street analysts. Telecom and consumer services, IYZ and IYC, are down in the cellar, and in fact, telecom has an outlook score that's fallen all the way to 0. They have the least support among Wall Street analysts, the worst return ratios, and the highest or the worst forward PE. And also they have a reduced projected growth rate. Overall, these rankings, I feel, have taken a slightly defensive turn with lower scores in financial and industrial. And the top 5 now includes defensive sectors like consumer goods and healthcare. But on the other hand, the top-bottom spread is 94, from a 94 for technology down to a 0 at telecom, and that is quite a wide spread, which really does show conviction in the rankings. Although, when you drop down to the second place and ninth place, that spread is only 30, 62 down to 32. So that's a little less conviction, but that top-bottom is very strong. Top-ranked stocks within technology and financials include Priceline, SolarWinds, Bank of America, and Berkshire Hathaway. And also, I wrote a piece back at the end of 2012 about the S&P Regional Banking Spider ETF, the KRE, and saying it was a good ETF for the first quarter. It has turned out to be that, and I expect it will continue to be. Thanks for listening.